Hey, it's Richard with Matthews Wealth Management. It's the end of July, beginning of August, so we're going to do a monthly recap. So as a reminder, these types of videos are based on clients who like to know the details, getting really in depth with the asset class performance. So we're going to cover 3 different time periods. First one we're going to look at here is the month of July. So it was pretty much a boring month if you look at the numbers. Just everything seemed to go up. We're still on a huge discrepancy from underlying economic fundamentals and then market numbers. So we'll just kind of do a quick recap. It gets more interesting when we're up back to year to date. But so for July, we kind of continue the theme of growth doing the best and value being left behind. In this case, though, we see that the values of large cap, mid cap, and small caps are all moving positive. One interesting change is that the large cap core or blend is actually outperforming growth for the first time this year. In the large cap realm, it writes itself in mid caps as well as in small caps, but in general, that's the theme we've been seeing since the COVID shutdowns, was that growth took off and then values were undervalued. Irony there. So international is up 2.3. Very interestingly, you see emerging markets up 9% on the month. So for whatever reason, there's a lot of interest in emerging market equities out there. TIPS, Treasury inflation protected securities, are starting to move up a little bit quicker, 2.3% on the month. Short term is almost nothing. Intermediate term is also kind of not too impressive, but we get a big jump on long-term bonds at the 5.3%. So that's kind of a common theme, is long-term has been where everybody's putting their safe money, just because there's no interest out there. You can't go to the bank and get any kind of CD rates. High yield, actually it's odd for that to be below on the long-term bonds, but high yields are all over the place right now. There's a lot of turmoil in what's even considered high yield, but we'll get to that later. Oil, slight recovery, 2%. We're still digging out of a hole there. Gold, silver specifically, has been absolutely taking off. And if you recall the previous market updates, silver was a big call that we made, and we're doing well with it, but just keep things consistent. Those are the asset classes we're following. But another 8.5% gain for gold in the month of July. S&P is a whole up 5.6%. And if you were to look at a moderate portfolio, kind of a 50-50 according to Dow Jones, that's a 3.84. So obviously trailing the overarching market by a little bit. So that's the month of July. It was pretty much everything going up again. The underlying economic fundamentals are not going up. They're going down. So it's this big discrepancy. Let's look at the last 3 months. So this is actually as of May, June, July is what we're looking at. So definitely post-COVID, just all up again, but we can see the same trend of value being left behind while growth outperforms. The best growth is actually in the mid-cap world. So if you recall back in March, one of our big reallocations was to move to mid-cap growth and large-cap growth. Small-cap growth is doing really well to recover as well. But that's the general trend, is growth is up and nobody cares about value. International to be at 10, that's actually a lot better trend line for May and June as opposed to July for international, but emerging markets at 18%. Again, that seems to be a very popular asset class. You see TIPS, how they've started taking off. That's a much bigger chunk of the 375. Short-term bonds, kind of, it's hard to find interest on the short term there. Intermediate term bonds, that makes sense. And long term at 7% on the quarter. High yield, this was the big bounce back after COVID. At the beginning of the quarter, we had really good high yield returns there. Real estate, 9.6, which is still digging out. And then oil, if we look at the recovery from, if you recall, the futures contract that went negative, obviously we've got huge returns in oil over the last quarter here. 73%, gold at a steady 14, S&P 12, just a big market recovery there, and a 50-50 type portfolio would be at 9.3 on the quarter. So going all the way back to pre-COVID and what the downturn actually incorporates, we can see the big discrepancies here and who hasn't recovered from the downturn. So obviously large cap value, mid cap value, and small cap value have been absolutely hammered. So most conservative or moderate type portfolios traditionally would have been the majority in the value side of equities, and that type of investing philosophy has really been punished here this year. So down 14, 20, and 25%. You can actually see that the blends or the cores of mid and smalls are also substantially negative, a -5 and a 16 there. And pretty much the only way to make money is in large cap growth, mid cap growth, and decent amount in small cap growth. We shouldn't really be, shying away from 10% in 7 months, but anyway, by comparison, it's about half of what we would expect and what shouldn't be moving as much as a small cap. So just crazy times. We see internationals down 9% on the year. Emerging is still down 1.5 on the year, even with these big numbers of recovery. Tips, this is interesting. The inflation protected securities here are up 8% on the year. So that is a much bigger number than what this is suggesting here. And a lot of it, again, is starting to pick up, but people are starting to get a little worried about inflation here. Short term at 3, that's very high for a halfway through the year, or a little over halfway through the year on short-term bonds. It just tells you the inflationary scares out there. Intermediate term bonds at 6, and then long-term, that's just astounding. We can have a 20% equity gain and a 19% bond gain, but you better be in the right ones or you could take a hit. It's really important to look at asset classes as opposed to just throwing your money at some stocks and some bonds. It makes a huge difference. So high yield, basically flat. So that's one of the most up and down roller coaster bond classes there. It's flat on the year. It's up 10 in the quarter, and it's up another 4.7 on the month. Real estate's still down about 10% on the year. They took a big hit. I think that it's going to continue to take a major hit if we actually get to evictions and defaults and everything that's being protected right now in the courts. So that'll be very interesting to see how that trend continues in August. Oil, still down 65% on the year. So it looks nice to be up 73, but we've still got a long way to go just to get back to where we were December of last year. Gold is just the stable, predictable 27% up. So inflationary, that's a big deal. 27, 14, and 8.5. That's pretty much the most predictable asset class that we have. Then S&P up 2.38 on the year, and by comparison, a 50-50 portfolio, let's just call that 0. So you've taken the downturn and you've recovered now if you've just thrown your money in one of those target date funds or something. So total practice at Matthews Wealth Management, like I mentioned in the last couple, we have short-term performance we're measuring. A lot of cash from the sidelines came in. We brought in a ton of clients in March and April as the market took a downturn. So that's what I'm counting short-term, is what have we taken advantage of on the short term in the dip during COVID. So the best short-term performance in an account that we have is 43%. The best long-term, which would be just a traditional long-term strategy that rolled over from last year and we made some reallocations. 1981 was a good year for Clemson. The worst year the worst account that we have is a negative 11.5 year to date, and that's a very aggressive speculative type account, and that took a big downturn during COVID. But the average overall, as you know, most of my clients are retired. I have some business owners and some younger professionals as clients as well, but our average is 1.06. You compare that overall with the 2.38 or the 0 from the S&P and the moderate, and that's something that we're happy with. We'll take a 1% up with the turmoil that we've seen. So hope that helps. Talk to your financial professional about which asset classes you are in, and also why and what kind of changes are coming. What kind of changes do you need to take advantage of? If you're up 20% and this one's on sale at 14, it might make sense to start taking some of those gains off the table and looking for new opportunities. So we'll be doing that here at Matthews Wealth Management over the next quarter with some clients, but if you've got any questions, feel free to call.